Good morning, everybody, and welcome to this latest in the IMAP series of webinars. It's a pleasure for us to be able to use this technology to reach out to you. And today, I know we have a really interesting topic, which is absolutely on point for the circumstances we find ourselves in, with Kanish Chugh from Securities talking about innovation and a way of accessing innovation. I'm coming to you today from a cold, wet and windy Sydney. This is the first day really when we've experienced winter, and I'm not liking it at all. So now, before I hand over to Kanish, let me just tell you a little about how we are handling COVID and how we've adapted the IMAP program. So as you can see on the screen, for the rest of this year, we've reshuffled our major events. The awards moved from a June awards date to an August awards date, and I'll talk a little more about the awards in just a moment. We've moved the portfolio management conferences, which are really important to us and absolutely central to the way in which portfolios delivered as managed accounts are being managed, and the issues that portfolio managers and security managers are facing delivering through this type of investment structure. We've moved those from their normal August date to November to give us the greatest possible chance of ensuring that we can meet. So in November in Sydney and Melbourne, and this year I think it's likely that we'll be able to take these to Perth as well. That's meant we've brought Investec back to September. So that's our technology conference, at which we try to draw together the themes around the adoption of technology today, for example. And in fact, on the IMAP website today, we feature a story from Adele Martin, an advisor who's making use of technology like this, like Zoom, in the way in which she's now delivering her service to her clients. We'll be featuring, of course, webinars on a monthly basis, and the next of these is with Macquarie Investment Management Limited, talking about some of the challenges of managing SMAs in an extremely volatile scenario. So Gary Ding from Macquarie talking about the issues around portfolio management in volatile markets. Now, before I hand over to Kanish, let me just say briefly a little about the IMAP Awards. I'd encourage those of you who are actively involved in portfolio management, in either managing or advising on portfolios, to consider entering the IMAP Awards. This will be the third year in which we've run it. There are 5 asset classes again: Australian equities, international equities, fixed interest, multi-asset class, and small caps. And if you have a portfolio in those, I'd encourage you to enter. We have an innovation award. The criteria are extremely broad. Show us how this is innovative. Tell us how it advances your use of managed accounts. And the final category is the licensee award. This really tries to speak to what I think is the driver of both innovation in advice and innovation in managed accounts, the adoption of managed accounts as a way of delivering advice. So now it's my pleasure to hand over to Kanish Chugh. If you have questions as we go, at the bottom of your screen, you'll see a Q&A button. Type in the question, and Kanish and I will see that. So without further ado, let me hand over to Kanish to talk to us about innovation and how to invest in it. Thanks, Kanish.
No, thank you, Toby. Look, I guess I wanted to say thanks to everyone for attending. Like IMAP, we're obviously all being quite flexible and nimble in the current times, and these webinars are a great way to communicate with the industry around different topics. It also flows on in terms of some of the work that ETF Securities is doing in regards to our partner series. So please feel free to have a look on our website in regards to that. Today, we're going to be talking about investing in innovation and its place in an investor's portfolio. And before we go on, I guess, I'd like to make sure that we all have this disclaimer. There will be, I'll show it at the end as well, make my compliance team happy. The agenda today is, I wanted to just touch on, the elephant in the room. We've all spoken about it. It seems to maybe tire on us from a media perspective, but the COVID-19, its impact that it's had on markets. We'll then talk around, and obviously, the topic of today is all about innovation and how we can invest in innovation. But the real focus was a new ETF that we launched, which is the ETF Securities FANG Plus ETF. And that has the ASX code FANG or FANG. But before we go into that and introduce that new product, really want to understand, what do you classify as technology? So how do you define technology? Because I think that definition of technology has evolved over many years, and where it currently stands is not what it was 25 years ago, 30 years ago. We'll then look at the alternatives that you may have to the exposure of our FANG ETF, and whether it's active or another passive or direct. We'll have an outlook on the FANG Plus stocks, and we'll touch on the FANG Plus stocks, and that's the FANG names as we all know them: Facebook, Apple, Netflix, Google, but also companies like Alibaba, Twitter, Baidu, and a few others. And then we'll look at, how does the FANG ETF fit into a portfolio. So again, it's been a tough year, or the past 12 to 18 months for Australia. Take out the COVID-19, we had one of the worst bushfire seasons in history. A lot of the country has and is still affected by the drought, and we're sort of hopefully seeing a bit of a light at the end of the tunnel in terms of the COVID-19 pandemic. We obviously are seeing restrictions ease, which is excellent to see. The current state of play in terms of investments, in terms of markets, it's volatile. Even just over the past few days, with the Federal Reserve coming out and, really, tempering people's views on the recovery that can occur, the impact that the pandemic can have. It's slightly unknown in certain countries, in particular the US. But you are seeing companies start to play out of that and start to actually really benefit or find opportunities, I should say, out of during this pandemic. And there are companies like the airlines, for example, that are struggling. So certain sectors are doing better than others. So there is hope for the future. And that's what we wanted to focus on today, which is that innovation and those high quality mega cap companies. So just to touch on, the COVID-19, you've probably seen this chart. Most of you will probably already be across this, but we look back over the past 20 years. We've tried to highlight a few different events, being the tech bubble, the global financial crisis, and now currently the COVID-19 crash. We saw that recovery in April, and we've sort of seen that slightly pull off a little bit now. I think it's safe to say there is going to be volatility, as I mentioned before. Volatility will continue until there's some sense of understanding of how we deal with this pandemic, whether it's a viral vaccine, whether it's, through increased social distancing and isolation. That is still unknown. But, I think certain countries are dealing with it better than others. What I wanted to highlight here is, I guess, in terms of how different areas of the market have really reacted to the COVID-19 pandemic. And we also had that trilogy of events in March, or February, I should say, February, March, where you had, the oil crisis, you had the COVID-19 pandemic, these events that started to come together and really form what we saw was that steep drop in February. What you did see here is the drawdown, and we've done this comparison. So on the purple is the NYSE FANG Plus index, which is the index that the FANG ETF does track, and against the S&P 500. Now, this is all in US dollar terms, so please keep that in mind. But the drawdown on both of those in US dollar terms was exactly the same, but it's what the rebound has occurred. And that's what we're seeing here, is that the rebound from the low point for the FANG index has been close to 41% versus the S&P 500 was 29%. Now, we'll touch on exactly why that may have been. With the COVID-19, just the fact that I'm sitting here doing this webinar to everyone, and everyone's sort of sitting in their homes, and some people maybe in their offices, but we can obviously see that being socially distancing, isolation, quarantine has impacted and changed our behaviors. And I'm actually going to go through a few of the names that feature in this index and feature in this ETF and how they've seen change as a result of COVID-19. But just on internet, this is just taken from, on a recent chart which we found, just looks at, there's massive increases across all different generations. And I think that's probably the key thing is across all generations, there is increased activity on the internet. I think being at home, and it's funny if you talk to people and you say, 10 years ago, had faced with this same scenario, I don't think we would have dealt with it or been able to be self-isolating for as long as we have been. And businesses, the impact on industries and certain sectors, a lot of sectors would have been much greater had it not been for technology and for the internet. So it's really interesting to see what we're doing now. You talk about watching funny videos or anything like that. That seems to be a bit of an increase, especially across the Gen Z. Now, I wanted to talk on technology. I guess we're looking at the FANG index. We're looking at that FANG ETF, and that particular ETF has 10 names in the index, but not all the names are classified as technology. If you take a Google or an Alphabet, you take a Facebook. Previously, that was technology, and the global sector classifications that we all refer to, which is GICS, they actually changed their sector classifications in 2018. And they actually reclassified a lot of names. And they do this on an infrequent basis. Every 5 to 10 years, they will go through and they'll change in industry classifications. And, this was one of the biggest shifts that they saw, where they actually looked at, what previously would have been technology, and Facebook, for example, is one such name, was technology. It no longer is. It's now classified as media and communication. And I think when you look at technology, it encompasses software, hardware, and semiconductors. And that's sort of your basic bread and butter of what is technology. Now, for us as ETF Securities, we launched this FANG ETF, and a lot of people say, well, we also have a sector ETF in our tech product, and that looks at the Morningstar Global Tech Index. And a lot of people say, well, why did you launch one over the other? Well, interestingly, there currently exists no crossover between those two ETFs, even though one is focused just purely on the sector of technology, and one is looking at the FANG or FANG style stocks. So companies like Facebook will never be in that tech sector ETF because it's not a technology stock. In Australia, we talk about technology. I think it's fairly well known. As a sector, we're heavily underweight relative to the rest of the world. You're also relative underweight in terms of even communication services to a degree, but it's really around that IT, information technology. Australia is well known for being overweight resources and financials. So you have to look outside of Australia for global innovative companies like the FANG name. So just touching on, and we'll talk in a minute about the actual index and the 10 stocks that are incorporated in there, and these are names that are in the index. But this is one of the reasons why you've actually got 5 names that sit there that are not in technology. They are in what's called communication services. Google, Facebook, both were previously technology, no longer are. Netflix, we all are big users of Netflix, I'm sure. And Baidu has a very strong presence in China, and as does Twitter as well. Again, all communications, media and communication services. And then on the other side, companies like Amazon, Alibaba, Tesla. We used to get asked when we launched that tech ETF 3 years ago, well, why is an Amazon in there? Well, reason being is majority of its revenue is generated from what they see as a retail sales platform. Now, yes, Amazon has diversified into many other areas. You're talking about videos, online streaming services, music, etc. You're talking about a cloud-based technology platform that they have. So Amazon is diversifying, but still is classified at this point in time as consumer discretionary. So the FANG ETF, and we'll talk about that in a minute, it encompasses and forms part of what we call our future present range. Now, for those that are aware of the ETF Securities product range, this particular range of products looks at what is the present, so established technology companies, and that's where our tech ETF comes into it. But then it looks at the future and what is really going to drive disruption and innovation. And that's companies, ETFs like our Robo ETF, which looks at robotic automation and artificial intelligence, our battery technology ETF, which is ACDC, our biotech ETF, which is Cure. And that's actually done, that's interesting. And I'm happy to talk to anyone that wants to later on. If you have any questions on it, please let us know. Because actually we're seeing a lot of companies within that biotech ETF actually working on current vaccines or testing kits and other aspects for COVID-19. So you do see some significant interest in that particular product more recently. But obviously the newest ETF in the range is FANG. The management fee is 0.35% per annum. And that's significant only because there is a competitor product and one that a lot of people would normally use for this type of exposure, which is sitting at close to 50 bits in terms of its fee. I think it's 48. So it's really important to note that it is significantly cheaper, and we're really trying to provide a solution to clients. It's a building block that we see in portfolios. So a short story about FANG. Not sure if many people would realize this or know, and it was something that I didn't know up until, did a little bit of research into the acronym of FANG. But it was actually coined by Jim Cramer, and some of you may be aware Jim Cramer hosts the CNBC's Mad Money show. So he came up with that acronym. Now at the time, it was only Facebook, Amazon, Netflix, and Google. Obviously, Google became part of Alphabet in 2015. In 2017, the New York Stock Exchange has expanded. They've launched indexes. They launched futures around this particular index as well. And obviously, we've seen that whole evolution of FANG and FANG's style names. Now, within this ETF and within the index, you have Apple, Google, Amazon, Facebook, Alibaba, Nvidia, Netflix, Twitter, Tesla, and Baidu. This is a total market cap of the entire index, so 10 names, $5.1 trillion. And this is where I think we're trying to understand it and talk to clients is this is essentially the main exposure. And funnily enough, when we look at some high conviction active managers, when we look at the NASDAQ 100 index, these are probably the names that actually make up a significant portion of those portfolios. So we wanted to provide a product that, whilst concentrated, really just gave people exactly what they needed as a core building block. I just wanted to show here in relation to other markets, those 10 names that feature in this ETF make up about 20% of the S&P 500, and there's been a lot of news around that as being a driver of growth. So why not try to capture that specifically? 12% of the MSCI World, and the ASX 2, and it's about 4.7 times the size of the ASX 200. So, significantly massive global changing companies. Now let's look at the index and the methodology here. So it's quite a simple methodology. The index is run by the New York Stock Exchange index company called ICE, which stands for Intercontinental Exchange. Now, this particular index, it's rebalanced every quarter, and we did do a rebalance, even though a number of other index providers and a number of other indexes didn't do a rebalance. We did do a rebalance most recently. It looks at common stocks or ADRs that are listed on any major US exchange. And I think that's important because for a lot of clients that say, well, I'm just taking the NASDAQ 100 as an exposure, or I'm just taking the S&P 500, well, you are going to miss out on some of these names as a result. Each stock that features in this index has to have a market cap of at least US $5 billion, and they have to be trading for at least 6 months, an average daily traded value of $50 million US. Now, there is a minimum of 10 stocks, and since this index was formed in 2014, those names have not changed, and that was created by the index committee. Now, as I mentioned, it rebalances every quarter, and that currently exists, the current name. So every quarter, and it's equally weighted. Now, I think that's really important there is all of our ETFs in that future present range have an equal weight strategy approach to them. The reason behind the equal weight strategy is for us as an ETF provider, we want to provide investors a vehicle to invest in particular exposures. Now, for something like this, if we were to take a market cap weighted exposure, you will have Apple, Amazon, Facebook, and Google pretty much being the dominant players. And you won't see what we're trying to achieve there is really just an approach that says you're buying into the thesis behind what is FANG. You're not trying to buy into just 4 of those names. And that's the same approach we use with our Robo ETF, with our Tech, our ACDC, or our Cure. You're buying into that thematic. You're buying into that sector. So we want to make sure that every stock in that particular exposure has an equal input. So just looking at performance of this particular ETF, this is done as at the end of April. So over the month of April, the FANG index in Australian dollar terms now, so everything moving forward is in Australian dollar terms, returned 11.25%. Now, what is the one that's probably more interesting is the 3-month data. So that looks at, February, March, and April. So essentially that volatility that we saw, and you still saw a positive return of 8.71%. Now, had you been exposed to the Australian market, you would have had a negative 20% return. The S&P 500, a negative close to just under negative 7%. The NASDAQ 100, and again, this is where we're going to talk about the differences, is you would have had a positive 3% return. So a lot of the drivers of those particular indexes, the S&P 500 or the NASDAQ 100, is actually driven by the FANG Plus names. So what are the differences? How can you access these types of stocks? Now, obviously, we've provided an ETF, so a solution there for you to do that. It is domiciled in Australia, so there is no W8 band form. You can obviously go direct, so you can buy directly into those names via the US market. Just note, obviously, slightly higher brokerage fees. There's going to be some, from a tax calculation perspective, I'm not a tax advisor, so I can't provide that advice, but we do know that there is slightly more tax complications when you look at it. Also, you would require W8 band forms, so depending upon how you want to speak to clients and the administration process, that can be a bit more difficult. And then it's the active management side. Now, there are a number of high concentrated global equity active managers that are looking at similar types of exposure. And I'll talk on in a minute the idea of active versus passive. And in that partner series, so it's the piece of content that I mentioned, we do this every week. Now, we actually touched on this idea of active versus passive, and actually maybe doing, being active with the passive products. And I think that's becoming more of a trend as you're getting more ETFs available to you to cover different exposures and being a bit more specific. You can be quite tactical with those and you can build quite a decent, quite a good portfolio just with ETFs. So you can be active, but with passive. So we will touch on the idea of active management. The more important thing there is obviously, generally they're unlisted. There are some listed active managers around, but their management fee is quite high. You're talking 1% plus on average, generally with a performance fee. So there is an argument to say, is it better to use this particular FANG ETF, for example, as a core, have that active manager, depending upon if you believe that you have conviction that they will outperform the index that they're tracking, or even the FANG ETF, and having that as your satellite exposure. So it brings down the cost of the portfolio, and it's a good complement between two. Now, already discussed, the other index exposures, are they available to you? And yes, for this style of stocks, you can get it via other indexes. We talked about the S&P 500, the lowest cost ETF available in the Australian market from iShares IVV. Again, you're not getting the concentration that you may want. You're not getting all the names. You looked at the NASDAQ 100. Now, there is an ETF that tracks that particular index, but again, a higher fee to the FANG ETF. And also, not all the names are included, not in that way in which the FANG ETF has been constructed. So I guess on that active versus passive debate, for those that are aware that I may know that are sitting on this call, I've worked on both sides of the fence. I do believe that there is space in portfolios for active managers. The problem is, though, on average, you generally find that a majority of active managers underperform the index. So this is just taken from the latest S&P Dow Jones SPI report. So this is going only to the end of 2019. And what you see here is on the international equities, and I'm focusing on that given this is the type we're talking about global equities at the moment. But 71% of active managers underperformed the index. Over 3 years, it was 75%. Over 5 years, it was 86%. So that's significant enough to tell you that, yes, there are active managers out there that do outperform the index. And by the way, the index that they're talking about is the S&P developed Ex-Australia Large Mid Cap Index. So there are active managers that can outperform that particular index, but you have to make sure you choose the right one. So that is the important part is, you're needing to make the correct choice. So that's why I talk about maybe it's possible to look at an active manager as a satellite and as an ETF such as FANG as a core in a portfolio. So I wanted to, bring that back into line. We just looked at the performance of the FANG index against the S&P, against the NASDAQ 100, but I've just used the Magellan High Conviction Fund. Now, these are apples to oranges in terms of the Magellan, as we've mentioned. That is one of the most well-known names in this active space. But what I wanted to show you here is the index or the ETF, the FANG ETF, had that been around for 1 year, would have returned 39.69%. The particular active manager there would have returned 1.7%. So very stark differences. And had you been using that as your core, you're obviously paying a higher fee as well. So just keep this in mind, is if you compare the index and the ETF, you may find a benefit of using something like an ETF as a core in your portfolio. So now let's look at the outlook on the FANG Plus names. And what we're trying to find here is, globally, there is disruption in terms of the digital nature of the world now. You talk about the total population of the world is about 7.7 billion. The number of mobile phone users, the number of internet users and active social media users. What was interesting was I recently conducted a study tour in India. Obviously, it falls off the line of the fact that we have the first ETF that tracks the Nifty 50 index, which is the Indian major market cap index. So the code for that is NDIA. But just before social lockdown and isolation and just before COVID-19 really took off, I was able to take a select group of clients to India and we did a tour there and we spoke to a number of companies. And in India, we found that there are close to 800 million mobile phone users. Now, smartphone users is only increasing. They have one of the cheapest internet data plans available, mobile data plans available for you. So these numbers here that we see on screen, talking about number of mobile phone users, number of internet users, as the emerging market comes online, is only going to increase. So that is something really important, that the names that we look at in terms of, Facebook, for example, they've obviously just recently entered the emerging market space in a big way. They took a 10% stake in Jio Telecom, which is one of the largest telecommunications company in India. So, already there, we're seeing investments from companies like this in that particular, in countries like India. So really trying to tap into the future growth. So I guess in terms of e-marketing, we're talking about social media, digital advertising. For a lot of us, we now read the paper online. We read it on our iPad, on our phone, on our laptops. Whilst I still like to physically hold paper and read it, I like to read a book. It generally doesn't happen, or the rate of the growth rate is not there. It's actually in decline. And so you're actually seeing this big shift away from traditional media ad spend to digital ad spending. And you can see there between 2018 and 2019, that actually flipped around. And that's only going to increase as we see more engagement of online, as we see more platforms come on. We talk about TikTok. So for those that are aware, it's the new social media platform that allows you to, recreate music and do dance videos, etc. You are seeing digital ad spending on there. And so you are starting to you're just going to see continual evolution of this space. In terms of number of users, these are some interesting facts that you may not be aware, but Google actually has a 93% market share of that search engine market. So for those that remember Yahoo, or for those that are still trying to use Bing, which is a Microsoft search engine platform, it's really Google that has really cornered that particular space of the market. Just in terms of COVID-19 and the impact on particular names, so this was interesting to see. Worldwide, there's 44% more people spending longer on social media. So that's Facebook, Instagram, Twitter. For a lot of people, that's actually how they get their news now. And Facebook has moved away in a lot of ways from being a platform where you share photos to a platform where you actually take in your news, take in particular interest, speak to community groups, for example. But the other side of this is messaging services. So things like WhatsApp, Facebook Messenger. Sure, all of us at some point in the past 6 to 8 weeks have used one of these services to either run a video call with family and friends, use it to communicate in some way. I know even in some of the emerging market areas, they're actually using WhatsApp for business. So there actually is now a WhatsApp platform just for business use. So it's become more and more important, and you're actually seeing the COVID-19 pandemic change the way in which we use these types of mediums. Now look at e-commerce and online marketplaces, and this is again a really interesting point. So these numbers were taken as of on the chart in purple, which is your retail e-commerce sales worldwide. That was in May 2019. Now I'm sure there will be some slight drop in this, and the forecast may change in terms of actual 2020 numbers. Obviously, given the impact that COVID-19 has had on one side for certain industries, but on the other side, you actually are seeing an increase in some way to use online platforms because physical shops have been closed. So the idea of Amazon has really become more important. I know there's been probably an increase in when we had the toilet paper crisis here in supermarkets in Australia, in terms of people trying to find toilet paper on some of these online platforms, but also in digital payment. So we already saw that trend happening in Australia. Cash was becoming less and less relevant. I know in Sydney CBD, you're actually finding cafes and restaurants, or cafes in particular, that were going completely cashless. So you only could use card or some form of digital payment to make purchases. But that is a growing area. Now, Alibaba features in this particular ETF. They obviously are the big users, 1.2 billion users of Alipay. But you're actually seeing Facebook try to enter this space. Now, I talked about that investment and they made in India, for example. They're actually via their company WhatsApp are looking to launch WhatsApp Pay. And I talked about WhatsApp being a service that a tool that businesses are starting to use. So you can actually now go in India, they're trying to create an easy, efficient solution for customers and clients to use online payments, because in a lot of emerging markets where this big space will be and this big growth will be, there's still a little bit of distrust for online. People still prefer cash, but that is starting to change. And China has been the biggest adopters of that space. The impact of COVID-19 on digital payment usage, and this was interesting, this is taken from Statista. It's as at April 20, 2020, so end of April. But just over 30% are now using more digital payments. Just under 10% are now just using digital payments and no cash. So whilst there is still, very much a trend of same as before, you are seeing a shift. And I think that's what's really important is the impact that this pandemic has occurred. It's actually allowing companies like these FANG Plus names to really benefit and find opportunities. We talk about e-entertainment and videos on demand. What's interesting to see here is the big shift that, with no sport, people are watching e-sport. So, every Wednesday, the supercar series, you don't need to watch, the supercar drivers now drive around and physically drive around Bathurst, for example. You can see them drive around the Nürburgring when they do that, or, around Monza, which is one of the famous tracks in Italy. So people are starting to increase their appetite, but Netflix, obviously, as of December 2019, there was 167 million subscribers. Now, I'm yet to see the data, but I know that has increased, and I'll have a chart in a minute on that. But you are also starting to see the use of, how we how we take in media, how we take in, with cinemas being closed and being a big push to say, well, can we launch those new movies that we had? Some are obviously trying to delay because the revenue that they may get from simple cinema sales, ticket sales, but some of them are shifting those movies that were going to be released off to Netflix. And I think what you do see there is just a big shift in how we consume videos, how we consume media. And so two companies in here within this FANG ETF, NVIDIA being another one. In particular with NVIDIA, it is one of the largest graphic processing unit companies. Now, obviously everyone will have had some form of NVIDIA graphics card, but what you may not realize is they're working very much in this particular space. So as streaming services increase, the reliance upon hardware like NVIDIA graphics card increases, because we're trying to make sure that the quality of that video is at the best it can be. We're also seeing the idea of, you're talking about e-gaming and online streaming. Facebook brought forward their launch of their online e-game streaming service. So where people watch other online games, people play games. So again, that is a big market and is growing as well. But just looking at COVID-19 again, so how that impact has been on Netflix subscriber rates. In the US and Canada, so North America, the impact was fairly minimal. And I guess that's because they probably cornered that market quite significantly. So it was only about a 4% subscriber growth rate. But Netflix has seen a massive growth in subscribers in international, and it's about 31% increase in that particular space. And, we really are seeing Netflix being quite adept at cornering different markets and tailoring content. So we know in Australia they are looking to do Australian only content. We've seen that in China, we've seen that in India, we've seen that in South America. But they also have changed their plans. So for example, in India, it's one of the only places you can get a Netflix mobile subscription. So for a much cheaper rate than you would normally get this traditional Netflix plan. So they're adapting to different markets and they're growing quite significantly in those areas. Now we talk about cloud computing. Essentially, all of us are using some form of cloud computing in our software, whether it's via our Apple phone, etc. Not many people may be aware, but Amazon has that 90% of Fortune 500 companies are using the Amazon Web Service. So Amazon is one of the biggest players in cloud computing. So again, a very interesting point. It's only going to increase. And I think that's the other thing. As we've had to now move and shift to working from home, the importance of cloud computing has only increased. So a lot of things have changed because in a very short time, because of the COVID-19 pandemic. And it's these companies that have already well positioned, some of them relatively strong balance sheets are well positioned to benefit from this change that is occurring in consumer behavior. Now we look at two other names in this particular index, being Tesla and Google. Tesla has a lot of, there's always a lot of talk around Tesla, but something that we can't deny is that it is a disruptor in the automotive space. The electric vehicle is going to be something that we are going to be driving in the future. Emission standards are getting tighter. A lot of countries have already thought of when are they going to ban production or sale of diesel and petrol vehicles. So the reliance as technology, and Tesla is at the forefront of this particular space of battery cars. Now, they sold over 367,000 vehicles in 2019, and a lot of the issues that Tesla may have had in production efficiencies, etc., trying to catch up to the demand that they had, they're starting to overcome. So we may see Tesla really become a much more stable, traditional car company, but they're also looking at other areas. And so, they're looking at healthcare. They're looking at, we're talking about, obviously SpaceX is there. They're looking at general battery technology solutions. And, we've seen that in South Australia. They're actually building the gigabit factory in Nevada. And when they started building it, the aim was to have enough battery storage to drive the battery use, electrical use for the total world population at that point in time. So they're developing technology that hopefully will allow us to become much more sustainable. Google is another one that's looking at autonomous vehicles under their Waymo subsidiary. So again, it's not just Tesla, it is other companies. And just on this idea of battery powered and autopilot, NVIDIA is actually one of the biggest developers of AI technology. So they have shifted their entire company focus from being just graphic card. They've used that basis and foundation of the processing units and that they had on the graphic card into AI software for autonomous vehicles. So they're actually working quite closely with a number of car manufacturers to help fine-tune that autonomous vehicle software. So where does the investment fit and can it vary? And I think this is really important. So obviously it really depends on where the type of investor it is, where on the risk spectrum they sit, what their goals are, because this particular FANG ETF, whilst it's seen significant growth, it can be seen as a growth play. And so depending on where you see it, it can be a satellite or it can be a core. But what generally we are seeing is that if you're using a high conviction global equity manager, or if you're using an S&P 500 or a NASDAQ, then this FANG ETF can be a replacement for that. So just looking at where it fits, obviously we've just done this very hypothetical here, so the core satellite approach. As I mentioned before, at a hypothetical, this particular ETF sits alongside, a MSCI World to provide an overweight to these particular companies. It could sit alongside an active manager, whereas in a way to bring down the cost of the portfolio, we've talked about before. And your satellites, if you wanted to go further down the line, so if you were a growth-orientated investor, you may look at some of the other products in the future present range, things like Robo, or if you want to be specifically focused on technology, our tech ETF, that would be seen as a tilt or a satellite in that particular space. Now, coming back to the growth of 100,000 as an investment. So had you taken all these companies in one package, so this FANG ETF, it gives you that obviously. Looking back over 5 years, you would have had from 100, you'd now be sitting at about 420,000. Had you just taken the NASDAQ 100, and that's something other important people don't realize, is the NASDAQ 100 has some dilution in it. It's not purely these companies. It's got some healthcare in there. It's got some other companies that you may not necessarily want exposure to. So again, it's about having a core focus and then maybe complementing it with something like a NASDAQ, or we talked about that concentrated active global equity fund. You'd actually be sitting on a lot less than you would had you just invested in these 10 names. And as I've just mentioned now, and we've gone through the outlook over the next 5-10 years, these companies are in a very enviable position to really benefit from the future and the changing behavior that we have in consumption and in consumers. Just in terms of the future present range, this is how it sits and what it all encompasses. So we looked at broad-based, which is our FANG ETF, pure sector, which is looking at the Morningstar Global Technology ETF, so tech. Then subsectors looking at biotech, so very much a healthcare focus. And again, very, very interesting right now, given the pandemic. And then we talk about, mega trends and thematics. So battery technology, again, specifically want to focus on it, something like AC/DC, or the idea and the trend of robotics and automation, so our Robo ETF. Now, before we get into the questions, I'd just like to say this particular FANG ETF, it is available on a number of platforms already, being NetWealth, Hub, and Macquarie. We are hoping to see it added on to a number of other platforms. In terms of research, we are awaiting Lonsec research, and that hopefully should be available in the next 4 to 6 weeks. So please do let us know if you require that as well. So happy to answer any questions.
So look, thank you very much, Kanish. That was really interesting to me. And we've had a number of questions come through from the audience. And the first of those is really just to recap on the question asks to recap on the benefits of a concentrated ETF, this concentrated ETF, relative to a broader technology ETF or the NASDAQ 100.
Yeah, so I think as we were discussing, the broader NASDAQ ETF is 100 names. It is slightly more expensive than that particular ETF that exists in the Australian market, close to 15 bips more expensive than the FANG ETF. It also doesn't give you the core exposure that a lot of clients use that particular index for. So a lot of investors, and this is one of the reasons why we brought this particular ETF out, was the appetite and the need that there was for it. They want just those particular names. They don't want the tail that exists. And so if you just want the FANG plus names, well, the FANG ETF is the only way to do that. As I mentioned, so the active managers, again, there may be an overlap, and we have seen that. So what the particular active manager we were speaking about may have some of these particular stocks in their portfolio, and they have an ability to pivot, but they're charging more than 1% for it. So how close to the index are they tracking? Are they outperforming the index? Is it worth using them if they're simply underperforming or simply tracking the index for the same exposure? So I guess that's the question you would need to ask yourself, and that's why the FANG ETF potentially can be used more as a core, and having an active manager as a satellite, as a way, because it's obviously you bring the cost down. You also still give an opportunity for that active manager to outperform and provide the alpha in the portfolio.
Thanks very much, Kanish. Now, before I go on to the other questions, just a couple of points I should have made earlier on, which is that we will be issuing CPD to all of those of you who've attended this. We will also be sending a full video. We'll be posting a full video of this webinar to our YouTube channel, and the slides will be available through the IMAP website. You'll all receive an email with links to the slides and to the webinar. Now, the other aspect of concentration, Kanish, is obviously risk. And so there are couple of questions which speak to the issue of risk. The first is, does the concentration risk lead to greater volatility than that broader market? And then secondly, and I'm thinking now, for example, you talked about Tesla, they've got a factory closed thanks to COVID, which they're now trying to reopen through legal action. So is there greater stock-specific risk in this approach?
Yeah, so I think that's very important. This is a concentrated view, it's a concentrated portfolio, so the concentration risk increases relative to saying taking the S&P 500. And that's why I was saying the idea between and how to implement it in a portfolio is using it as alongside something else. So diversifying your entire portfolio. Obviously, this is not your entire portfolio. It would be sitting alongside something like a global equity active manager, or an S&P 500 or something along those lines. And for clients that have an ability to take on a bit more risk, because as we're seeing, the growth is significant as well. So yes, slightly more volatile than you would say the S&P 500, but it's how you're using it, and for the particular right investor, this could be really beneficial.
Yeah. And now let's talk about kind of some of the stock-specific characteristics. So taken overall, thinking about the PE ratios of these 10 stocks relative to the market and the projected growth. I know it's looking into the future, but the projected growth of these stocks relative to expected growth, particularly for Australian investors. Do you have any view, or do you have a position on PE and growth?
Yeah, so on the PE side, again, a lot of some of these names in this particular index, you're talking about something like a Tesla. So the PE is significantly higher than what you would say for the S&P 500 or the ASX 200, which is why that's, I guess, the key point there is you're investing in growth, you're investing in future. And generally, when you're looking at growth-orientated investments, the PE will always be slightly higher. So this particular index, it's sitting at the moment, looking at here, I think it's close to 57.8 compared to the IVV of 19.82. So it is something that people need to be considerate of and to be aware of. But I guess just coming back to the idea of concentration, if you were to look at any high concentrated active manager, and the fund I spoke about earlier, their concentration in their stocks is probably equal to, if not more, than the FANG exposure that you may get. So I guess that question of concentration, it really determines the type of investor that you're using this fund for and where it fits in that portfolio.
I mean, one of the things which is of interest to me, of course, is that a number of these names, which are in the S&P 500, the top 5 names in the S&P 500, account for about between 20 and 25% of that. So you're getting a good degree of concentration, whichever US index you look to.
I think so. And just Toby, on that, I think if you looked at the performance and the contribution of performance on the S&P 500, actually a majority of the performance has been driven by those names. So that's the other side of it, is the performance is actually coming from these names that are driving those broad indexes.
Now you talked about the actual underlying composition of the index. One of the names, 10 stocks is not many. Who determines that composition? For example, Microsoft is not in there, which is one which you might have thought would be a natural.
Yeah, so the index composition, it's determined by, I mentioned New York Stock Exchange index provider, so ICE, Intercontinental Exchange. So they're the index provider. They sit there on that committee. They coined this index, or they developed this index at a time when it was just the FANG names. You're looking at FANG style names. So Microsoft, we get this question, why isn't Microsoft in there? Microsoft is still very much from a revenue generation perspective, not looking at this predominantly software. So it's never to say that Microsoft may not feature in this particular index looking out. And, you've talked about companies like Disney, for example, as they start to innovate and develop, that may also be a feature in this particular index looking out. But really it's looking at names in which are generating revenue on disruption and the future and the innovation that we see in the world. Microsoft was and has been at this point in time seen as very much in that old school pure technology play, which is why for us, we have our tech ETF where you do have Microsoft in there.
Now, thinking about the composition, Alibaba, Baidu, both Chinese stocks, Tesla building a couple of factories, NVIDIA heavily exposed to the Chinese market. So to what extent is this index effectively a China play?
I don't think it's a China play. To an extent, it is a China play, but it's actually a global play. I think that's how we need to view this. These are companies that are global in their nature. They're global in their revenues. They may have obviously, heavier share of revenue from certain countries. But as I mentioned before, Amazon, Facebook, Netflix, Apple are all looking at India, for example. So in a lot of ways, these companies are trying to diversify their entire revenue stream. They're looking outside. China becomes a big market for them, but it's not the only market.
Right. Okay. Now, look, our final question. We couldn't we couldn't be thinking about Australian investors without asking about dividends. So, to what extent is this is this a dividend-paying investment?
Yeah. Look, these names, they don't pay a high dividend. As I mentioned before, it's a growth play. It sits in that particular area of the portfolio. So yield on this is very low, close to about 1%. There is a semi-annual distribution though on the dividend. So if any stocks do pay a dividend, it will get paid out, and dividend reinvestment plans are available for investors as well. But it is sitting more on the growth side than the income side.
Okay. Actually, I said last question, but there are a couple more that have just come through. And your point there about distribution touches on it. With a quarterly rebalance, I imagine there's sort of regular trading activity as a result of that rebalance. To what extent is this then presumably any profits that are made on the sales are paid out as part of those distributions?
Yeah, that's correct. So all our equity ETFs, any gains that are made within the fund, they get paid out as an annual distribution in June. So that's what we will do as well for this particular ETF. So the June 30 distribution includes both any income, any dividends, and then any capital gains as well.
Okay. Technical question here. Sharp ratio compared to the NASDAQ.
Yeah, so I don't have that available right on me, but happy to send that out post this webinar.
Okay. And we've touched on the issue of the 10 stocks. I guess the question is, the question is, will the ETF always be just 10 equally weighted stocks? And I think you touched on that briefly during the presentation, but could it be further diluted in the future by the committee? So I guess the question is really one of policy and approach of the New York Stock Exchange to the underlying index.
So yeah, so it is a minimum of 10, but those 10 names have not been touched since 2014. But they do look at it on a regular basis to see, are there companies that fit that style of what would they're classifying as FANG style. So, you know, in this nature of disruption, but being market leaders, being the basically at the front of the pack, and that's what you're getting with these companies here. So not to say that there won't be more than 10, but at this point we haven't seen any change in the history of the index for the past 5 years, 6 years. So safe to say it's not going to be a massive amount that you're not going to see sort of another 20 or 30. That's not the idea behind this index. All
right, now this is the final question. So corporate actions, share placements. So to the extent that, you know, how are they dealt with? I imagine the question speaking to placements and action, rights issues and so on and so forth from the underlying, the underlying companies.
Yeah, look, generally as an ETF, it's the same approach that we take with all the equity indexes. So we generally don't participate in any of the placements, etc. Our idea is essentially we will essentially buy those stocks. So on that side, it's sort of a minimal view in terms of our undertaking of any of those.
Right. Look, Kanish, thank you very much for your time today. As I said, it's been fascinating for me, and I'm sure for the couple of hundred people who've participated. As I mentioned, our next webinar focuses on both the practical issues of running managed accounts and the implementation issues associated with managed accounts in a volatile market. From personal experience, I know that it's an issue which portfolio managers need to give considerable attention to, and that the practical issues of transactions and corporate actions, for that matter, are real issues. So thank you for participating today, and we look forward to you joining us again. And in particular, we look forward to you putting your managed account portfolios into the IMAP Awards. The close date is the 26th of June, but don't delay. Thanks very much.